How's it going out there? It's November 15th. My friend Curzio, it's the Wall Street Unplugged podcast. We're back to the headlines and tell you what's really moving these markets. What happened last night? Excited, getting home from watching my daughter in the playoffs, watching the Eagles, and man, Washington just beat the crap out of them. A couple crazy calls, but wow, controlled the whole game. It was a great job by them. NFC East is awesome. Good for the Eagles, too. I'm an Eagles fan. Bad for that guy on ESPN. I think ESPN made him write an article that just went up just before the game. ESPN is having the game on TV, so they're trying to promote as much as they can. And this guy highlights, and it must have took him like 5-6 hours to do this whole article, showing the Eagles could go 17-0 and who they're playing, the point spreads, and all this crap. And they lose. They lose Washington. Favored by over 11.5. But I think it's good. I think it was funny when you're comparing this team and you look at Jalen Hurts has never had a comeback win ever, even though he should have had one yesterday if that guy didn't fumble that bomb. But, losses are good. Makes you try a lot harder, and you have to work on so many new things, but it's why football is great every given Sunday, especially in divisions. I don't care, even the NFC East, any division. I don't care how great you are, how terrible you are. When they play each other, they just know each other, and usually those games are tight and tough. So really good job by Washington. Played great. Ruined my Sunday, especially that terrible, horrible call at the end of the game. Wow, stayed up all day, and then all of a sudden, a ridiculous penalty, and that's it. It's over. Eagles didn't even get a chance to get the ball back. Anyway, let's move on since a lot of stuff's going on. The market doing very, very well. What do we have? Starting, last week, CPI showing inflation finally moderating. We have solid earnings from bellwethers like Home Depot and Walmart this morning. Home Depot's guidance wasn't that great, but still pretty decent numbers. Then we had the producer price index also showing inflation is moderating. And what's going on? It's leading to a huge bid in equities because we're seeing a dollar retreat, which is very important. Pay close attention to that dollar. So the market was crashing as the dollar surged. Now it's starting to retreat and yields are falling, especially at 30-year, which is now below 4% to 3.8%. If you look at technicals, especially quant funds, stuff that we have access to, been unwinding these huge short positions to the tune of $225 billion over the past couple of days. And there's experts that track these funds, like 2 or 3 of them, that I get notes from. And they're incredibly bullish, highlighting that tens of billions more is going to likely flow into the market over the next few weeks. And you look at S&P 500, has taken out some key trend lines, including its 50-day and 100-day moving averages. So technicals rising, beating out fundamentals right now, but it's nice to see stocks rallying. Most people are long. And it's very, very, very common to see these types of huge one-day moves like we saw last week, 7% in the NASDAQ this week. So another 1.5%, 2% move as I'm taping this. But it's very common to see these types of huge moves inside of bear markets, especially with the major indices, where you don't see them going up 2-3% a day unless, someone's leaning one way or the other. In today's market, still a lot of money sloshing around, especially these quant funds. Any kind of trigger, the upside or downside, you see massive flows go back and forth. That's what we're seeing right now. When I look at this market, it reminds me why it's such a great strategy buying long-dated puts. We see massive moves like this to the upside. They don't hurt you. It allows you to stay long in stocks or your favorite names over long-term, which we have done with Curzio Research Advisory, Curzio Venture Opportunities, focused on small and micro-cap names. Those positions are doing well in this rally, very well. But by buying these long-dated puts, it's also giving yourself the opportunity to make 100% to 300%, even more returns betting against certain stocks and sectors. And let me tell you something. This is a unique market, one you don't see often. Not during the dot-com bubble, 2000, when that crashed. Not during or shortly after the credit crisis. Not post-COVID, when we injected $11.5 trillion, both fiscal and monetary, into this market and watched every single asset class surge to all-time highs into this year. It's different. Because there's a huge gap between the companies who will be able to navigate the crazy conditions we'll likely see next year and the ones that won't. And guys, make no mistake, because we will have extremely, extremely difficult conditions where the Fed is not lowering rates anytime soon. Still, through next year, aggressively removing liquidity from the market. QT, quantitative tightening, that's called. A market where the Fed is intentionally trying to crush demand and cause much higher unemployment. Those are the conditions. We don't make them up. That's the way it is. That's what happens when you have inflation. I know saying there's going to be winners and losers inside this crazy market, it sounds almost contradicting. Like I'm playing both sides here, which I hate because I hate seeing when analysts get on TV, they say, well, the market's definitely going to crash 30%, but it could go up over the next 2 years. This isn't that. Let me explain the importance of this, because I've never seen this before, and this is what you're going to see next year. And if you play it right, you're probably going to have the most gains you've seen in the past 5 years, at least probably the past 10 years, with market conditions all over the place. Because in bull markets, what do we see all the time? Entire sectors go high. Everybody makes money. Everyone's a genius. Cab driver's a genius. Nieces and nephews, half your age, genius. Oh, this is so easy. Portnoy, this is easy. Wall Street's so freaking easy. Oh, my God, it's awesome. But entire sectors go high. Cloud, FANGs, Web3, banks. Same thing with bear markets, right? Entire sectors usually go low. Look at gold stocks. Look at energy pre-COVID. Every energy stock got nailed. Some more than others, yeah, but they all got nailed. Real estate stocks this year, which are down 25% year to date. Semis, every semi got crushed over the past couple of months. And for most of this year, like pre-October. So it didn't really matter what cloud stock you bought from 2017 through January 2020, which was COVID peak. The entire sector did well. Yes, you could have said, well, I had NVIDIA and I had AMD that killed it. But even Intel doubled from that time frame. Mid-2017 to pre-COVID highs. Early 2020, Intel doubled. So he still made money. It didn't matter what gold stock you bought over that same time frame. They all sucked. You lost a little bit less money in the producers, but even the producers came down a ton. Just everything came, there was no separation. Going forward into next year, we are going to see massive, massive separation in companies within the same sectors. Like Norwegian Cruise Lines will thrive. All the debt is fixed. Strong balance sheet. Focus on high-end consumers, while Carnival is in terrible position. Massive debt, higher rates, focuses on the lower to middle class consumers where inflation is really hurting those people a lot more with fuel and food prices. And the Fed's going to continue to make it more and more difficult removing liquidity from the system. Where JP Morgan will thrive while Credit Suisse, news under the radar because everything, Walmart's taking center stage and producer pricing these things. Credit Suisse just sold a significant part of its securitized products portfolio to Apollo to help lower leverage significantly. Look at Ford with saddled with massive debt, loses money on every new EV it sells, while GM's in much better position from a balance sheet perspective, is more focusing on autonomous vehicles. Ford said, we're done with autonomous. We're going to EVs. They're autonomous, along with EVs, gas vehicles. With Disney Plus, will continue losing billions on streaming. As average revenue per user is declining. It's under $4 compared to close to $12 for Netflix. What does that tell you? It shows that their audience really doesn't want to pay for its platform due to the lack of new content. You need more new content than just a few Disney add-ons or Star Wars add-ons. Your best content's not going to that platform. I talked about this past couple of weeks since they reported. But that lack of new content is killing. While Netflix is about to place ads on its site where it's not going to impact its user base that much because people love Netflix. Why? Because they're the best new content in the industry by a mile. I think it's dead to me. It's coming out their new season in a couple days that we watch. I mean, it's Cobra Kai. It's constantly. Stranger Things, constantly. Things that people go home to see. And you know what? I don't mind watching a commercial or two in the middle of that. I never had to do that before, but that's fine. I'm not going to cancel Netflix. But obviously, just the way the platform is for Disney, you're seeing the average revenue per user go lower and lower because they're signing up more people basically for very, very low price, or most of them for free. But now what are they going to do? They're going to raise prices and place ads all over them? Good luck with that strategy. With Netflix, they're going to start making money through the advertising model, which is basically free money. It's free money. People are going to pay them. You just put a couple of, their content's already there. I can see Netflix, which is doubled off its low already, going up another 30% next year, while Disney could easily fall 30% and still be expensive. It's trading at 25 times forward earnings, while, I mean, earnings are going to be, what, $4.50 they're projecting for next year? They were supposed to be $7 at the end of 2021 originally. That's what they had to keep lowering them and lowering them, to the point where now everybody's getting it. Streaming is the worst business in the world, and Disney didn't come up with some revolution idea for Disney Plus. They had to do it because they had to. Everything was closed. They were more impacted during COVID. Even after COVID, their parks, certain capacities, theaters, cruises, everything. They had to do something good for them. They did something. People bought into it. They didn't care about the numbers. All they care about is how many subscribers. They didn't care if anyone was paying for it. Now it's coming back to kill them. And they keep pushing this strategy and losing more money. But there's a big difference, and they're both in streaming. We're seeing a great example of this with what? Walmart from today. Did you see Walmart's numbers? And this morning, solid guidance. They're able to sell a lot of its inventory, which went up significantly the past 2 quarters, especially in apparel, which is killing a lot of companies, while significantly, and here's the key here, raising prices. Raising prices. I mean, unit sales were down, but the average ticket price was up significantly, meaning they were able to pass on higher prices to the consumer, especially in what? Groceries. So even those higher prices at Walmart, and they're raising those prices, are still lower than most competitors, especially for food. And Sam's Club is killing it. They had the Walmart Plus programs, millions and millions of people signing up. It's like $100 a year. You have consumers unlimited free delivery, fuel discounts, free access to Paramount Plus, early access to Black Friday deals, which everybody loves. But they're able to provide a monthly fee on existing customers, having them pay more, kind of what Costco does. You got to get the membership and all the shop, which is a fantastic strategy. They're also buying back $20 billion worth of their stock. They increased their buyback program significantly. So you have Walmart, a company management team that's adapting to tougher conditions, where the CFO, in an interview this morning, while they reported this results and why that stock is driving the Dow higher today, it's up about 7%, he said pocketbooks are stretched. People have less discretionary income or less disposable income to spend on things. So they're looking for value. And that value is Walmart. Because even as they're raising prices, it's still cheaper than a lot of other people out there and companies. But that's an amazing quarter. Let me ask you a question. Do you see all retailers being able to do this? Being able to reduce their massive inventory that quickly? Being able to pass up higher prices to their consumers? Being able to buy back a ton of their stock? I mean, not $20 billion. The size of Walmart's massive, but they have a great, strong balance sheet. So Walmart's a winner, and think about it, because this is for a retailer, Walmart, that is going to see earnings decline around 10% next year based on estimates, and also saw inventory rise 13% year over year. So we have a stock which is rising significantly. I think 150 was the 52-week high? He's less than 8% off of that right now. But you have a stock that's rising while earnings per share are expected to fall next year. And now Walmart's trading at 26 times forward earnings right now. Do they deserve that premium? Yes. I think they do. I don't know if I go and tell you to buy Walmart at this level, because now expectations are really, really high, where if they do come out and the inventory levels do skyrocket and you're going into the holiday season, where holiday season is horrible for retailers, is terrible, absolutely terrible. It's everybody fighting to discount products as much as they can to get that sale. They have Black Friday deals now coming out. I got from Walmart, got from Best Buy already. I remember Black Friday used to be actually Friday. Now it's like weeks ahead of time. Eddie Lampert went to one of our gatherings at street.com, and I think it was a Christmas party. And Kramer's really good friends with him back in the day. And, just Sears, huge, billionaire at the time. I know, what happened to everything with him. But anyway, and he was saying, he's like, I wish we just closed for December. He's like, it's the worst. As a retailer, it's the worst. It's horrible. It's tough. It's tough to make money because you have to discount significantly. That's what people are looking for. They're shopping from site to site to site to site to site to get the best price on whatever product. And now so many apps that compare everything. But they deserve that 26-time forward P. Do they deserve that multiple? Yeah, I mean, with that quarter. But the question you have to ask yourself is, will other retailers be able to command that multiple while likely having worse metrics? No. I mean, retail's not back. You're not going to say, retail's great, we got to buy all the retail companies. I mean, yeah, we got a lot of retail companies reporting tomorrow, breaking down in a second. But my point is, you're going to see management teams here. They're going to implement new strategies, cost-cutting measures, where they're going to have their costs go lower while earnings per share go higher. And these are the names that are going to significantly outperform next year. However, we are also going to see a lot of names fall 30% plus from these levels. As the tough market conditions for next year, they are still 100% intact. Nothing has changed. And you can say, well, the CPI number, Frank, what are you talking about? Showed moderating inflation. It's up 7.7% year over year. We're looking for under 2%. If you're looking at the terminal rate for the Fed, it still hasn't gone lower. It's still 5% for next year. Terminals where they expect it to peak. I mean, 3-4 months ago, we were looking at 3.5% as the peak. Now it's 5%. But don't worry, CPI is moderating a little bit. How long can we moderate when Walmart's raising prices? All these companies that are beating are raising prices. Home Depot reported they're raising prices. They're seeing less unit sales and they continue to raise prices. They're still passing off these higher prices. And it's not just for their higher input costs. Their margins are actually increasing, which means they're even adding more onto that. And they're getting it for now. But it tells you, for those who think inflation is just going to come down tremendously, it's crazy. And I say those conditions, those tough conditions, still 100% intact. We're rising. PPI reading from today showing producer prices moderated very, very slightly. They're still up 8.3% year over year. They were up 8.4% last month year over year. But 8.3% is better than 8.4%. Let's celebrate. That's insane inflation right there. That's not things are great. We needed to see moderation. We were going to see it. The Fed's raising rates at its fastest pace in a modern Fed era. And it's crazy. And a lot of these rate hikes aren't even being factored in yet into next year. It takes months and months and months. But it's not like conditions are great, go all in, we're fine. No. We're going to have a market where the Fed will continue raising rates into next year. Definitely 50 basis point hike. They all came out and said it, even now. You're going to see more reports tomorrow coming out, too, from Fed governors. But most of them are like, yeah, don't think we're pausing anytime soon. And you can't. Because I was under the impression 3-4 months ago that when I got bullish that, okay, once you have higher rates and you stop, you're not going to see inflation come back. But you could. I mean, just to see what these companies are reporting and car companies are reporting and the prices that they continue to raise, it could. I'm just automatically going to shrink from here. So the Fed continue to raise rates into next year, probably into March, continue to take liquidity out of this market all next year through quantitative tightening. They're shrinking their balance sheet tremendously. They shrink it by trillions. They will not be lowering rates anytime soon with inflation still rising over 7% year over year. If it's rising, it's 5% year over year. They're not going to lower rates unless we see something break significantly and the market absolutely collapse. Earnings fall well off a cliff. Let's see. They're going to keep its initiative of what? Destroying demand while trying to force much higher unemployment. And think about that for a minute. The Fed's initiative is to destroy demand. They're doing it industry by industry. Now you're seeing semis. You're seeing separation. You're seeing discounts in semis where, hey, you know what? Taiwan semi, Buffett just came into it. That could be a great bargain. Some of them are, some of them aren't. AMD still trading at 25 times forward earnings, and they're not growing earnings from 23 to 24. That's a pretty high multiple for not growing earnings. NVIDIA is still expensive. But if you think about that for a minute into next year, and you're like, wow, I got to go all in, and they're missing these big moves. You don't want to miss the big moves. You want to be long your favorite stocks. But think about how many companies are going to be impacted significantly. Talk to your friends. Talk to their businesses. You're hearing it out there. got friends who are lawyers who are busier than ever, and now they're like, hey, Frank, you know any companies that need help with seeing, housing market, same thing across the board. People are emailing me. It's definitely different. You're seeing people cut back. And some people saying, hey, we're starting to see it. Well, if you're starting to see it now, where do you think it's going to be in 3 months and 6 months with the Fed, again, removing trillions of liquidity from this market, keeping rates relatively high, not lowering anytime soon. And now we have an S&P 500 that's trading at over 20 times forward earnings. With earnings going to decline, definitely year over year. They could be down more than 20% year over year. Not based on the current estimates, though. But you'll see it. And the base case scenario, Morgan Stanley came out with it, is the only one that came out below $200. Right now, the expectation is $237 total earnings for the S&P 500. That's the number when they say the S&P 500 is trading at 15 times or 17 times, right? They take the S&P 500 price and then they divide it by earnings. That number's 234 right now, I think, 234. Now you see Goldman say the base case next year is going to be 200. Now it's 195. Morgan Stanley, they're going to keep going lower and lower and lower into every quarter, just like they did last quarter. Looked like, wow, 75% of earnings beat estimates. Well, 80% would have missed estimates if you kept the same estimates from 3 months prior, which showed that earnings for Q3 was expected to grow 10.5%. However, they lowered them so much, they were only expected to grow 1.5%. And what do we see? A lot of companies beat those lower expectations. At the end of the day, the earnings number is the earnings number. And you have to pay attention to that. And what I mean by that is, I don't care if you expected to earn 550 and then you bring it down to 450 and you earn 460, it's still 460, which means your earnings are not growing as faster. Stock prices are going up, so your PE ratios are getting higher, getting very expensive in a market that you don't have the Fed no longer to bail you out. Something we haven't seen in the past 12 years. So if you don't think it's going to be difficult market conditions next year, think again. Be prepared. And if you're wrong, you're still long some stocks. We get nice portfolios set up. When I look into next year, it's not really a question on being bullish or bearish and saying, well, I think the market's going to crash here, the market's going to go up here, whatever. I think we're going to have both conditions based on what stocks you're focusing on. That's why staying long your favorite names while buying long-dated puts on struggling companies that are going to have to continue lowering earnings significantly over the next 2 to 3 quarters is a strategy you're likely to make a killing on. Because, yes, you have data like this showing, okay, we're moderating finally, whatever. What happens if we don't moderate? What's going to happen? Everyone's going to be like, wow, the Fed's not going to lower anytime soon. But regardless, look at the massive layoffs. Leading into all these earnings calls, look how many companies fell by 20% plus in a day, even some of the largest companies. Look over the last 2 earnings periods. What do you think is going to happen over the next 2 or 3? That's what you're betting at. You're betting right now, well, okay. If you're going right now, the market's nice and high. You have some companies where you have Walmart in your portfolio, you're loving those earnings. A lot of other companies' earnings, we have very good earnings from many of our companies in our portfolios. But what happens over the next 2-3 quarters? Are the cost cutting, is it enough? Demand destruction. Liquidity removed from the market. How many companies are still sitting? They don't have the balance sheets of the Walmarts or the Exxons and stuff like that. They don't have those. And you need one bad quarter for these things to come down tremendously, and you're going to make a killing. A killing on some of these puts. And plus, using this strategy, it keeps you grounded, right? You're not pulling your hair out or losing sleep with every 10% plus fall in the markets over the next, 2 months, followed by a 6% one-day pop where you're like, holy shit, what's going on? I mean, it's impossible for the average investor to navigate through these markets. You're not trading. When you have your jobs, you're away from work. You're not looking at the markets all the time. That's why you listen to the podcast. So you follow some of our newsletters to help you out with some of these things. But it keeps you grounded. Because how do you navigate through these markets when you see this? These massive, huge 25% decline in the markets, 30%, followed by a one-day 7% move because inflation is up 8.3% instead of 8.4%? Think about that for a minute. But this strategy of being long your favorite stocks, only long-dated puts, that's why we have Money Flow Trader. It's what it does. product run by Ginia, which has booked massive gains this year. Massive. Including closing out a triple-digit position last week. Sounds crazy with the markets moving the way they are, but still, during earnings season, one of those companies fell tremendously. Tremendously. But that's what you're betting on. And the only money you could lose is the money you put into that trade. So say if you have a $100,000 portfolio, have a $10,000 portfolio, take 5%, 10% of it, even 5% of it. If you lose that money on those puts over a year, it's probably because the market's going to go significantly higher and you're long. But it allows you to sleep at night. It allows you to play both sides of the markets, which is something that is extremely difficult to do. Where Money Flow Trader sucked when we first, again, looking at earnings 2018, knowing that they weren't going to increase in 2019 and the market went up tremendously. I thought 2019 would be tremendous. I thought 2020 the market was going to crash. It crashed because of COVID, which is easiest to see. But Money Flow Trader was not a good newsletter because everything in every sector was going higher and higher and higher. And you could say that for the past 3 years. You could say that even outside a few periods from 2010, post-credit crisis, to 2020. So when COVID started, in January, February, around there, a lot of stocks went higher. So you're not used to seeing these types of conditions where the Fed's not going to be there for you. They're not lowering rates anytime soon. They are telling you we are destroying demand. That's our job. And to significantly raise the unemployment rate, which we need to do, which means the economy, that's not good. I can't say it any better than that. That's not good conditions for the economy. That's why we're definitely going into recession next year, which means earnings are likely to fall much more because the word recession just creates negative sentiment, which means companies are going to tighten up. They're not going to spend as much. They're not going to provide crazy forecasts. They're going to cut CapEx. So growth is going to be very, very limited. And there's some companies like Walmart that will do a great job, but there's not going to be many. And you have to be careful out there. And you want to protect yourself because the next year, 2 years is going to be extremely difficult. But it's a period where you can make excessive gains using this strategy. If you want to learn more about Money Flow Trader, just go to CurzioResearch.com. Go to Google. Learn about it. It's not too difficult. You can do it right through your account. You need like level 1. You might need level 2 in terms of options, but you can only lose the amount that you put in, so there's no leverage there. It's like buying a stock and it goes to zero. That's the most you could lose. Unless you assign something, and the next day you'll be able to trade it. It's very easy to put these trades in. You follow Money Flow Trader, Jenny tells you exactly how to do it. You don't have to worry about implied volatility, ways. You just got to do exactly what she says. Buy this put below this price, limit order, enter. Boom. That's it. It's that simple. Well, if you have any other questions, just email me at frankcurzioresearch.com. But I keep pushing this because it's a strategy that I'm making money on. It's a strategy that everyone who owns Money Flow Trader, most people that own Money Flow Trader are doing very, very good. They're sending me screenshots of the gains that they're making, which is incredible. But it's something that can make you a lot of money in this market. So it's definitely worth researching and trying. That's up to you. Whether you want to do it through Money Flow Trader, you want to do it yourself. But it's a great strategy going into next year because we're going to see massive uncertainty. And the Fed's initiative has not changed, not even 1%. Nothing has changed. We still see massive inflation. We're not going to see lowering rates. We're going to see quantitative tightening. They're going to continue to try to destroy demand. They're going to continue to try to raise unemployment. None of that has changed. We're seeing moderating, which of course we had to see. But next year is going to be very, very difficult. And you don't have to worry about these massive moves in the market because you're going to make money either direction the market goes, most likely, if you're following the right person and you're buying the right puts. And you own the right stocks. So questions or comments, feel free to email me at frankcurzioresearch.com. We'll be back tomorrow with Daniel Kreese to break down some more earnings from retailers. Let's see if Target, going to be tough to follow up. Walmart, Lowe's, they follow up from Home Depot. Let's see if there's separation there. TJX, they're all reporting before the bell tomorrow. So we'll break those down. And very important indicator tomorrow, retail sales for October, which could also move the markets. So lots of fun stuff. We'll break down tomorrow, and I'll see you then. Take care.